Series of educational webinars designed to enlighten you on a variety of investing and trading ideas. Today's session, winning with long calls, the secret formula for consistent profits. Now, have you ever heard the expression, you got to spend money to make money? Well, most long call buyers try to do just the opposite. They spend as little money and in hopes of hitting a home run, ultimately realizing little or no gains and the loss of their original premium. When long call buyers should be looking for calls that already have value, intrinsic value, as these call options increase with value and return a considerable profit gain with just small price appreciations of the underlying asset. Hello, everyone. My name is John Rowland, Barchart Senior Market Strategist, and buying calls is the easiest form of options trading, and therefore it is the widely most used option strategy. A call gives the purchaser the right, not the obligation, to purchase a stock or equity at a specific price before a specific time. The appeal of calls is provide speculators with leverage. In other words, they can control a large amount of a stock for a proportion of its absolute value. And that leverage generates large percentage profits with slight rises in price by the underlying security. And since the price of the call is paid in full, there is no margin, and the risk is limited to the premium paid. So stick around as I offer my take on long calls, which is a bit more conservative and slightly more expensive approach, but it yields consistent results on higher probabilities. Before we get to that, please welcome Barchart's project director and our moderator, Jean Baker. Hello, Jean.
Hi, John. Happy Wednesday.
Happy Hump Day.
Yeah. Hump Day.
2 weeks before Christmas. Are you ready?
That's right. We're counting down to the holidays. I think I'm ready.
Ready? Get all your baking and decorating done?
Maybe not. I don't know. If not, I'm coming over to your house for all those meatballs that you said you're going to make. So
yeah, we'll have a whole bunch of that.
Yeah.
So stick around before the end of our session this week as well, because we're going to talk about our calendar. So remind me on that, Jean, as well. Right?
I will. Yeah, John's got something up his Christmas sleeve for the next week or so. We'll talk about it at the end.
All right, ready to get started then?
Yes, let's go.
All right, let's do this first. All right, so just a reminder that today's session is for educational purposes, and decisions to buy, sell, or trade any security or commodity or any investment is best made on the advice of a qualified financial professional, and under no circumstances shall we be liable for any losses or damages that you incur based on a result of trading or investment activity based on any information that you receive through barchart.com and our services. Okay. So let's go here. And let's talk about long calls, options, long call screeners. So the long call strategy involves the purchase of a call option, and this is where the goal is to profit from an appreciation in the price of the underlying security. The risk is limited to the premium paid, and maximum profit is theoretically limitless, but is more likely capped by what is the implied expected move between now and the call's expiration. The key to success is twofold. First, finding the right candidates of stocks or equities that are exhibiting bullish tendencies, and a strike selection that will reflect a positive outcome of an up move. Now, many retail traders chase a dream of choosing strikes prices above current price for two reasons. The call premiums are cheap and the potential rewards can be significant. The reality is that a large significant price appreciation is needed and the stock price has to trade above the strike in order to become profitable at expiration. However, with a slight change in tactics, choosing a strike that is already in the money allows smaller positive price movement to have a greater impact on price of the call option. Now, this more conservative approach has a higher probability of success, but the trade-off of lower potential returns that of out-of-the-money calls. So let's do this. First, let's review the mechanics of, or the Greeks of long calls. So delta is how much an option price is expected to change for every dollar move in the underlying stock. Now, long calls have a positive delta somewhere between 0 and 1, meaning that if all things are equal, the premium increases as the stock price goes up. And this also can give us a rough estimate of the option's chance of expiring in the money. So a call option with a delta of 0.50 has a 50-50 chance of finishing in the money. Now, delta is a positive for long calls, and the higher the delta, the more the price of the call acts like the underlying security. And a delta of 0.08 or 80 means that for every dollar move in the stock or equity, the option will change by 80 cents. Theta, or sometimes referred to as time decay, is negative for calls, which means that they gradually lose value as expiration approaches. And Vega tells us how much an option's price is expected to change when the implied volatility of the underlying asset changes. For long calls, higher volatility usually increases the option's premium. So a stock who is just starting to move could present an opportunity to buy into rising implied volatility. So we have two inputs that are a positive impacts on the price of options, high deltas and rising implied volatility, and one negative impact, which is theta, time. And time has a price. Our goal, again, option premiums consist of these two variables, time value and the cost of holding an option until expiration, and that intrinsic value, the amount of a strike price that is in the money. Now, our goal is going to be to buy an option with the minimum of time value and the maximum of intrinsic value. Now, we're going to accomplish this by looking at in the money options, because they have more intrinsic value and less time value. Now, the rule we're going to use is that we're going to look for those strikes that have a time value that is less than 2% of the stock price. Why? Because then just a small 2% move in favor of the stock will cover the cost of time. Out of the money calls, which have no intrinsic value and all time value, require the larger price moves to cover that cost of time. So this is a very simple rule for our strike selection. But the second part of our setup is choosing the right candidates. Now, although there are many ways to find good candidates, Barchart provides numerous lists based on technical and themed ideas. So let's go back to Barchart. Okay, so we're under investing. And the first one I want to show you is called the uptrending stocks. Now, these are large caps with upsloping 5, 20, 50-day moving averages. They have rising volume, and they are at least 20% from their 52-week high. In other words, plenty of room to run. Another list is called the breakout reversal. Now, these candidates are found based on Bollinger Bands, a powerful volatility indicator, and rising volatility is usually a good predictor of future price movements, and I will add, agreeable to calls. And then finally, we're going to go over here to stocks and new highs. Is finding stocks that are making new highs. Now, the old adage is that you can't make a new high without taking out the old high. And these candidates typically continue their price trends. Now, these are just a few of my favorite lists or candidates that I'm going to start looking for long call opportunities. You might have your own, but this is just a jumping off a point for candidate selection. All right, so let's do this. And I'm going to go back to long call here. All right, and let me do this. Let me refresh. It probably hasn't refreshed since this morning. And what I'm going to do here is I'm going to move away from the long call screener that we have on our page, and I'm going to show you my screener for long calls. And one of the benefits of being a Barchart subscriber or member is that you can create your own screeners and you can save them. And a premier member can have multiple or unlimited screeners. So what I've done is I've loaded up my long call in the money screener. And so what I want to do here is I want to show you what my filters are. So let me open up the set filters setting. And by the way, I will offer you an opportunity to copy this. Right, and let's start from the bottom. And the bottom is moneyness, and that how far is our strike away from current price. Remember, we're going to look for in the money. So we're going to look at in the money of 5% or greater. Now, my experience is that's probably where you're going to need to start looking. Security type. Notice here we can easily adjust for ETFs and indexes, but we're just looking at stocks today. Strike price. Strike price is just going to be for identification purposes when I'm doing my analysis. A days to expiration, 15 to 60 days. What we're trying to do is we're trying to capture current price movement. Now, we could expand this window to 90 days. Anytime I like buying an option, I want to make sure that I have a lot of time on my side for that stock to appreciate. But the caveat is the more time means more time premium. Volume, 1 month average volume, call volume. So this is just a minimum threshold. Now, depending on your starting list of candidates that you're going to look at, you could dial this up to maybe 10,000. But what I wouldn't do is dial it down. Delta, we're going to set between 0.5 to 0.9. Now, why don't we leave this open-ended? Well, this eliminates a lot of those extremely in the money calls. For instance, like a $50 call on a $300 stock. Ideally, we're going to find our best candidates in the 75 to 90 range. Then we have what is called the percent time premium ask, this rule that I just offered you. We're going to look for those that were only 2% of the price of the call is time premium. Now, this is where Barchart does the math for you, so you don't have to break out your calculator all the time. Let's talk about this in some absolutes here. First of all, if you're not familiar where to find all of these different inputs, there are many different categories. But let's look at options analysis, and you can see here it says time premium. And if I open that up, notice I have percentage time premium to the bid, to the ask, to the middle, and to the last trade. Now, the reason why I use the ask is because that's kind of that upper threshold, right? I know that if I can find something that's 2% or less on the ask, probably going to get something even lower. Now, you could set it up based on a bid or the mid or the last price. Now, a lot of times with a lot of these calls that we're going to look at, there could be an illiquidity issue. In other words, there might not be a lot of volume. And so we have to understand that market makers set up bids and asks based on where they make money. In other words, they might offer you an opportunity to lift an offer to buy that call, but they have already baked into the price that once you buy that from them, they have already locked in some profits. So one of the things you can do is you could try to middle, right? You could try to middle between the bid and the ask, especially if it's a large range in price. But here's a little tip for you. So for instance, here I'm in Apple and I'm under long call, right? And here's a lot of different long calls here. But so for instance, let's say let's look at the 260 here. We can see that the bid and ask on this one, right? Excuse me. The ask price here would be $21.65, right? We could buy that for that. But what I could do is I could go in now. I have to make sure that I already set up my expiration, whatever expiration that date we're going to do, and we're looking at the 37 days out. So I can go here where it says volatility Greeks, and I can look at the 260 call and look at what is the theoretical value. And what I usually do is I will set my bid at the theoretical, right? The offer, the ask was 2163 here. The theoretical is 2155. And you'll be surprised how many times you will get that trade based on the theoretical. That's just a little trader's insight, how you can lower your entry costs, all right? Average to range percentage. Now, what this does for us, it has two purposes. It shows us the percentage of the average to range, the range that we can anticipate on any given day for our stock, particular stock or equity. But average to range is also a measurement of volatility. In other words, the greater the average to range, the more volatility. Again, rising on volatility is a good thing for us in call options. So what I'm done here is I want to find an average to range that is 1.5% of the price of our equity. And what this does for us in theory is that a directional move of that 1.5 or greater could help us recapture that time premium. So what I'm doing is I'm identifying a little bit higher volatility markets based on their ATR and the fact that if I can get a daily movement which is within that range, then there's a good opportunity I could maybe time my purchase a little bit better in order to find a better opportunity to enter the market. Now, before we go and do that process, I just want to show you that, well, let's leave that for something for a little bit later. Okay. And then finally, I'm going to add the trend seeker. Now, even though we're probably going to start from a bullish list of candidates, this kind of identifies or guarantees that I'm only looking at uptrending candidates. Okay. All right. So let's load up those results. And, you know, I know that you might be catching this. Some of you are familiar with this. Don't get overwhelmed by this large number of potential candidates. We're going to show you ways how to narrow it. But typically what you're going to find that this field of candidates is very manageable. In other words, once we go to, like, for instance, flip charts of the underlying assets. Oops. Come on, Barchart, wake up. There we go. And it's going to start loading these up. What you will find is, and it's still loading up here, is that you have maybe a lot more manageable candidates. In other words, we might only have 50 or 60 potential candidates. The differences, or what we need to be aware of, is really it's the number of potential trades or strike options based on each symbol. So you can see for like Apple here, we got about 6 or 7, AV again, 6 or 7. And again, if you have 50 candidates and you have 6 or 7, and then you start getting some of these larger numbers. Again, we're going to show you some ways how to narrow this down. All right. So let's kind of walk through one of these examples, and then we'll look at ways to refine some of our selections. Okay, so let's look at Apple. I think Apple is a good market for us to look at for a couple reasons. First of all, it's one of the most widely held stocks, and I'm kind of looking at a different strike prices here, and I kind of like that 37 days out. And so let's pick, where's current price? 278. All right, let's pick the 260. We showed that one already. So I'm going to pick out the 260. Now, what I want to look at here is, first of all, is we're going to buy the 260 call, which is about 6.6% away from current price. And the cost is going to be $21.95. Now remember that an option represents 100 shares, so the cost here is $2,195. Now a lot of you are going to say, hey, that's a lot of money for an option. But think about this. If I were going to buy 100 shares of Apple at $278.48, well, that would be $27,848. So I'm taking control of 100 shares of Apple for only $2,195, a fraction of its absolute value. And this is that leverage that I talked about. Now, the other thing we can look at there is our price, that premium price to our our ask. How much are we paying for? And you can see in this case, the time value of the premium that we're going to pay is only 1.25%, and that our break-even price would be $281.95. You can see that is only about $3.50 above current price. Again, a small price movement in order to get to that break-even value. If I was going to look at, let's say, a long call, and maybe let's say a $290 call way above current price, well, notice that my break-even price is $293, more than almost $15 above current price. Okay, so the next thing I'm going to do is I'm going to come back in here and I want to go back to my long call. There we go. I'm going to go to this little graph here, this little chart. And what this does is it opens up this little chart here. First of all, notice that on our profit loss grid, the green line represents current price, and this dotted green line represents where we reach break even. Again, notice how closely we are to break even based on current price. Again, if I go to that 290 call and I do the break-even analysis, notice how far price has to travel before I get to break even. And that is a definite plus for buying in the money calls. Now, the second thing is I'm going to look at is, we can look at our Greeks. And again, on this one, we can see the delta of this particular call is 82.8. Let's just round it up and say it's 83. So that means for every dollar move in Apple, this option is going to increase by 83 cents. Again, a much better probability than, for instance, if we looked at the 290 call, I bet you that delta is probably closer to like 25 or 30. And then, volatility, right? Is our volatility rising, or is it low, or is it high? Now, typically, I will like to find those candidates that are in this yellow, where we have a little bit more volatility, because I'm going to buy an in-the-money call where I'm not going to pay a lot for time premium. But rising volatility, good volatility, is going to help increase the value of my options. But here you can see Apple is a relatively low volatility candidate, which could be an opportunity for us to find, a breakout move. And then what is our expected move? So in this case, you can see the expected move for this option, strike, and expiration, 37 days out, is about $12.33, or about a 4.4 percentage move. So that puts us at around 290. Again, a lot of retail traders would say, oh, I'm going to expect a big move in Apple, and I'm going to come here and say, oh yeah, the expected move is 290. But 37 days from now, if we're at 290, what is that 290 call going to be worth? Well, it's going to probably be worth nothing, right? Because it doesn't have any value as it comes to expiration. It's not in the money. But our 260 call is going to have a value of about $30 minus the $21 we would have bought, or $22 here. So we would have a net profit of potentially $8 or more. Now, what we could also do is take this expected price movement, and all things being equal, times our delta, and I believe our delta was 83, means that we could potentially, all things being equal, without taking in consider volatility and some little gamma here, about $10.23. Now, why is this important? Well, that's our goal. That's our target. That's what we're going to try to achieve based on this trade. Now, this is where we have to understand that this strategy does not have the high percentage returns, but it does have a nice return. So if I take the $10 potential profit divided by the cost, $21.95, that's the ask, I'm going to make about 46% return on my money. That's a pretty good deal for only 37 trading days. But the other thing I'm going to do now is, oh, but first I go to the chart is I want to also look at trend. Right? Again, I want to find those candidates that have a positive trend. So you can see we have a positive trend, green arrow, in the short, medium, and long term. And the inclination of the arrow basically tells you the strength of the trend. So long term, very, very strong. Intermediate and short term, a little bit softer or weaker, just means that maybe we're slowing down a little bit or we're not really accelerating. Again, reflective of volatility. But then what we're going to do is we're going to go to the chart. And let's go to flip charts. There we go. Thank you. All right. So here's what we're going to do now is think about this. We know that 290 is going to be the expected move, but our profit is only going to be about a little bit more than $10. So then what I need to do is how much am I going to risk in terms of this trade in order to get that return? Now, we could just say, hey, I'm going to buy a 260 call, and then I'm going to, as long as the market stays above 260, I'm going to risk a 1-to-1 ratio. Maybe not wise. What I want to do is no matter what strike that I choose, I want to find some kind of support, either technical support based on previous price movement, or looking at that risk to reward ratio. In other words, here we're looking to try to potentially make $10. So if I'm going to make $10, well, maybe I'll risk $5, right? So a $5 move against me based on the option divided by my delta would mean that Apple would have to fall about $6 from current price to where a point where I would lose 50% of my initial premium. And again, I could look at that value where current price is and see how that lines up. So I could look at things like, for instance, some supportive moving averages. I could look at Bollinger Bands and look for a supportive means. Or again, look at just structure itself to help me define where I think there could be support. And what I like to find is a swing low between my strike and near or close to that 50% retracement based on this delta acknowledgement. Now there is one template that I think is really good for you to use, and that under Barchart templates is our 13 EMA in pivots. And what we can do here is on game day is I'm going to look at the lowest support level. And these are floor trader pivots, and these usually act as levels of support and resistance. And then again, I'm going to look at this and I'm going to look over a period of time to see if I can find levels of support based on price action that fall in line with our pivot lines. And what I do see is that the second pivot here does show me a previous level of resistance and recently a level of support. And notice that that value around 275 is only $3 lower. We said we could lose up to $6 before we lose 50% of the premium, which would probably put us closer to our third support. So again, that's how you can do a little bit of risk management on that one. All right. Okay, so let's go back to our set filters. And so this is where we're going to kind of narrow down the candidates, okay? And remember we said we want to look for those potential candidates from a list, a watch list, or a group, or a trading idea. So I'm going to open up the filters, selectors, and again, I could have my own personal list or watch list. I'm going to go to Barchart pages. And so the first one we'll look at is our technical investing ideas. I'm going to add those. And there is our uptrending stocks. And bingo. See how we went from like 1,500 candidates down to 32. So here's the 32 candidates that look like they're breaking out, have some potential on the upside, a lot of potential on the upside. And so, you know, again, let's kind of just eyeball what's going on here. And the one I saw this morning was interest me would be at UPS. And again, you know, let's kind of look where we are. We can see that currently we're at $98, and it could be any one of these strikes. Now, what I do want to point out to you, and this is kind of that caveat that I was saying about before, is let's say we do the 30-day expiration, and you know, I could see that the 90 call and the 85 call both have about 3,000 or 4,000 open interest. This is kind of a safety net for us. We know that these contracts have interest in them. In other words, market makers are going to probably give us a little bit narrower bid and ask. Notice the volume is light, though. And that is why we kind of want to be a little patient in our process. But I bet you if you went to, let's say, 86 or 87, you'd probably find very little or no open interest. So again, I would default to those strikes that have a greater open interest. All right, so let's use the 90. I kind of like that one, right? So we're going to spend $9.75. We only need about a 1.3% move to get to break even from current price. That is not too far, right? And let's do this. Let's change from our main view to our filter view. And we can see, again, that idea of the, right? Our ATR here, we can see for UPS is 2.18%. So again, remember that template that I showed you that on game day that you can use to help you. Well, here you can see that in one day, there is theoretically the possibility that we could, if we timed our buying correctly, we could negate that time premium literally in one day. How cool is that? Now you can see our delta here is about 78, 79. But let's do this. Let's go back to our profit and loss. Let's look at our expected move. And again, our expected move is only $5.35. Again, what would that be? All things being equal based on our delta. Well, $5.35 times a 79 delta. That means we can anticipate a potential profit of around $4.22, 23 cents. So how much am I only going to risk? Right? Maybe I'll risk $2, right? Maybe $2.10. $2.10 divided by my delta means that we could see the price of our options fall by about $2.06, or the stock, excuse me, the stock price fall by $2.65. What's my trend? Right? Very positive uptrend. And again, let's go to our chart. And there is UPS. And current price is around 98. And what do we say? Well, I could risk about $2.65. Well, that would put me down below, $96. Again, probably looks like our nearest swing low is closer to 95. So that's probably where our risk would be. But again, if I did not get this fall through and it fell back below 96, then maybe I might exit that particular trade. All right. All right, so let's go back to our set filters and let's get rid of technical analysis. And we're going to go back to our bar chart list. This time we're going to look at breakouts and reversals. I'm going to add that. Our bullish bands. Again, there's a nice webinar about how to use this page. I think we did this about a couple months ago. That'll show you how to, each one of these are different setups. Again, 190 potential setups, but if we look at this in terms of candidates, probably maybe only about 50 or so candidates. Now, the one that I did look at this morning was, let's see if it pops up again. There it is, GLW, right? And again, Bollinger Bands, we can come back and you can either add a template. I've already created a Bollinger Band template, or you could add it as an indicator. What I want to look for is, I want my Bollinger Bands to be kind of narrow as we're breaking out and then them turning out. That is a really good sign that we're going to get increased volatility and a follow through in price. Now, what is really interesting about this one is not only are Bollinger Bands, they may be a little bit wide, but they have been kind of trading sideways. We are making a new all-time high. What I want to probably stay away is from this type of scenario, right? Where we have really wide Bollinger Bands and we're outside of the Bollinger Bands, right? We kind of want to be in that, narrower band. And one of the ones that was kind of interesting to me is, again, narrowing bands that are now starting to widen out. These would be much better candidates. Okay, let's go back to one more example. And we're going to get rid of Bollinger Bands. And we're going to go to new highs and new lows. Again, you don't have to use 52-week highs and lows. 6-month highs and lows or 3-month highs and low highs can make good candidates as well. And let's look at, again, 153. But again, if we look at, the collection of candidates we have here, what I do see is a lot of miners have popped up today and a lot of financials. Again, an idea of kind of thread for looking for certain sectors. But the one that intrigued me, and let's see if it's still up there. There it is, Rio Tinto, another miner. And what I see here is, again, remember, this is making new 52-week high, right? Not only is it making a 52-week high, but if we look at this over a longer period of time, we are making multi-year highs. But in this case, this is actually a candlestick pattern. This is called a rising method. And this is a very bullish indication that we're going to continue to see price action. So again, we talked about the idea of using chart formations to help us define risk. Well, that low is at $72.59. Now let's break down this trade. And I think I have to go to page number 2. Yep, there it is. And look at that Rio Tinto trade. There it is. All right. So again, look at how much our ATR is, about 1.7%. But notice that a couple of these strikes here, the $65 strike, we'd only have to pay about 1% in time per premium. The 62.50, we're paying less than 1% premium. But let's use the 65. Again, what's my trend? Nice, very nice trend. What's my expected move? Right? Well, $3.66. What would be what based on our delta? 86, right? Probably about $3 we can anticipate. And that means that we probably want to protect ourselves to about $2 below, where we lose half the value of our the premium that we're going to buy. And then again, if I go to my chart, we're currently at $75. 75 minus $2 would be around $73.50, right? Again, look at here, we're at $72.50. So about a $3 risk on price action, but in delta, 3 times, what was our delta was 80. Well, that would only about be $2.70. So this is a good way to manage your risk on one of these particular trades. Okay. All right, so let's do this. I see some questions. Gene has been answering a lot of them, helping you guys out. Let me see if I can get through a couple of these, Gene, for a second. Okay.
Hey, so John, question for you. You had mentioned a webinar about using templates. Is that just our basic chart template webinar? Somebody would like to know a little bit more detail on that, and I'd like to point them in the right direction.
The EMA pivot template would be on the last webinar we did on the trader's cheat sheet.
Okay. Okay. I'll send along the link to that. Now, while John is going through the questions, I'd like to just point out for everybody that the option screener that he is demonstrating today, the long call option screener, this is part of a Barchart Premier membership. We offer a free 30-day trial. And if you are not a Premier member, we highly suggest that you take us up on our offer and go ahead and sign up for that trial so you can screen for these candidates yourself. I'm going to go find that webinar now and send the link over.
It's
okay?
the most recent one, I think, Gene. Okay. So Conroy asks, can we use this for 0 DTEs or do it? Yeah, the process is pretty much the same. You know, you don't have a lot of time decay because there's not a lot of time left. So, but yeah, again, you know, if you're playing in a very short period of time frame, you might want to think about those higher deltas because then your option is acting more like your underlying stock. But you know, there's dynamics changing options, right? The gamma's a lot higher, and then smaller price movements affect those options that are closer to current price. So it's a whole kind of different game. Again, you know, the reason why I kind of use 15 days, I really want to see a price movement, let's say in the next week or two. And again, I'm not looking for the home run hits. I'm only looking for if I can get 10, 15, 25% return, you know, that's a good return. Think about it. If I have a $3,000 option that is in the money and it makes 20%, that's $600, right? That's very doable, right? In a very short period of time based on the in the money and the delta. But if I pick an out of the money strike, well, let's say I only spend $300. Well, in order for me to make $600, you know, 100%, right? I'm probably going to have to see, you know, more like a 20% price rise or a 30% price rise. And that's really the game that we're kind of doing. We're going to use that leverage of delta and a little bit more time. Okay. Looks like Gene's been answering a lot of these. Good job, Gene. Chris says they go slower on. I'm sorry, Chris. Trying to get it all in there. You know, all webinars are recorded, and you can come back and watch those. I apologize for that. So primary pages, again, those will be in our slides, Chris. You can look those up, and on the slides there is the links to those pages. Okay. Andre asked, should we not examine the bid ask as a process? And again, Andre, yeah, if you're looking at the bid ask and it's super wide, go ahead and check out your open interest. If you have no open interest, that's not a very active stock. That's kind of why we wanted to have that higher threshold on more active stocks. But if I have open interest, and even though the volume is very slow today, there's a good probability that I can get a trade somewhere between the theoretical value and the ask, somewhere in the middle of those two. Okay. All right. Stanley, I think we talked about how you can manage the downside risk based on structure, based on supportive technical analysis, or this ideal of taking our delta and the price movement of that as well. Okay. M. Jones, all the slides are for all of our webinars are attached, and I'll show you where to find that. Okay. All right. So I think that is pretty much most of the questions. Okay, so again, I think it was Andre was asking, yeah, the slides here, here's the links of those pages that'll have what I would consider some good candidates. All right, so let's talk about some takeaways. Okay, first of all, we're going to create a plan that starts with identifying bullish candidates. Where do we find them? Under our investment page. Maybe you have some of your own ideas. But the idea is we want to start looking for those candidates that have been trending on the move or are poised for bullish volatility. In other words, Bollinger breakouts, new all-time highs, new 52-week highs, new 3-month highs, right? Some kind of catalyst that is going to propel it higher. Now, because we're going to use in-the-money recalls, we only need a small movement, and that's why if we can find those where our ATR matches up with that 2% rule, there is, in theory, we could time a better entry on the day we get into the market, and within 1 or 2 days, we could pay for that risk, that 2% time risk in our trades. Where an out of the money call, we might need 5 or 10% price movement before we can start making some money. Understand that delta, theta, and vega aren't just comparison metrics, but they're also these variables that it can help us to anticipate how much a call option price will change. Now, I just did the assessments mostly on the delta, and I think this is a really good tool for risk management. Look at your expected move divided by your delta, and that's going to tell you the potential profit. Now that you know your profit, then you can decide how much are you going to risk of that potential profit, and a risk to reward ratio 1-to-1, 2-to-1, 3-to-1. And then how much would that be reflective in your price movement? So if, let's say, you had a $10 potential profit and you wanted to only risk $5, then you would take that $5 divided by your delta, and that will tell you the price movement of your underlying asset that you would be at risk. In other words, how much would the price of the stock have to fall for you to lose that 50% of your potential profit? Or you could do it based on the actual value of the call premium that you paid. You could times that by the delta as well. Okay. And then remember that trend and volatility are our friend, not just trend, but volatility. And while we kind of want to find those that we're seeing volatility rise And again, on our profit loss grid, look for those that are kind of in that yellow. And that time is your enemy. So what we're going to do is we're going to embrace trend and volatility, and that's why we're going to pick low time premiums. Okay. And then here you can take a screenshot of this. Here is the link to my screener in case you guys want to use my screener to start your process. Okay. All right. I see a lot of great comments. I appreciate that. All right. So, Gene, let's do this. Whoops. There we go. Back to bar chart. All right, folks. First of all, next week, upcoming webinars. We do not have one next week. And this is actually our last webinar for the year, the last one for me and Gene. So, first of all, I want to thank Gene, and I want to wish you, Gene, a Merry Christmas and a Happy New Year. And I want to thank you so much for all that you do for me and for all of our viewers. So thanks a lot, Gene. I appreciate that.
Appreciate it, John. Thank you. Thank you as well.
Thanks, Gene. Next week, let me pull up my calendar. Next week, the 17th, we don't have a session for a regular educational session. We're going to have a special session that is based on our show that we do on Fridays, which is called Market on Close, or MOC. And that is going to be in our regular time frame. So if you hadn't had a chance to check out MOC and see what we're doing, it's a little bit more intimate. We look for a lot of alpha. We look for emerging trends. We identify news stories and things that are happening. That will be at our regular time that we do meet this time. So that would be 12 o'clock Central, 1 o'clock Eastern time. And then in 3 weeks, on December 30th, that's Tuesday, December 30th, we're going to do a special Q&A MOC. And again, that one will start at 12 p.m. Central, 1 o'clock Eastern time. Again, you don't, right? Those are all free, and you can have access to them. You can either through our page right here, Barchart Live MOC, Market on Close, or you can watch through YouTube. All right. In that session, we're going to do Q&A. So if you want to send in a question to be answered, you can send those to marketonclose@barchart.com. We will not return to our regular sessions until January 7th. And on that one, we're going to have a special guest, Jim Van Meerden, who is of our chart of the day. And Jim and I are going to talk about kind of ways to look at our portfolio, some of our favorite screeners, and kind of ways to look for trading ideas. All right, folks, let me turn my camera so I can give you guys my best wishes. Folks, from the Barchart family, I want to wish all of you Merry Holidays and a Happy New Year, and of course, the good of all trading.